On September 10th, Associated British Foods put out a trading update that, well, it basically sent investors running for the hills. The reaction was fast, it was harsh, and it wiped billions off the company's value. So in this explainer, we're going to dig into a few key questions. What exactly went so wrong? What's the plan to fix it? And, the most important question, where does the stock go from here?
And look, when I say the reaction was severe, I am not kidding. The stock tanked over 13% in just one day, on huge trading volume. This wasn't some minor miss, This was a major re-rating of the stock that really caught the market off guard and completely changed the story around the company. So, what on earth happened?
This line from Deutsche Bank really hits the nail on the head. It gets right to the heart of it. The whole downgrade was mostly driven by some really disappointing news from ABF's crown jewel, Primark. But it was also made worse by some bigger economic headwinds and, frankly, ongoing problems in another part of the business. Let's break all of that down.
Okay, so to really get our heads around this double-digit drop, we've got to start with the numbers. The market was expecting things to keep looking pretty good, but what they got instead was a sharp U-turn, all driven by the company's most important business, Primark.
Here it is. This is the headline number that did all the damage. For the second half of the year, Primark's group-wide like-for-like sales, that's basically revenue from stores that have been open for at least a year, are expected to be down about 2%. After a really strong first half, this reversal was a huge negative surprise, and it was without a doubt the reason the stock just fell off a cliff.
But here's the thing. That negative 2% headline figure, it really doesn't tell you the whole story. Not even close. In fact, it's kind of hiding this massive divide. When you actually break Primark's performance down by region, you see it's really a tale of three completely different markets. One is absolutely booming, one is kind of holding its own, and one is, well, it's in decline.
So on one side, you've got the bright spot. The UK market was surprisingly resilient, actually gaining market share and seeing some positive growth. And the US? Whoa, it's on a whole other planet, with sales just rocketing up 23%. But then, on the other side of the coin, you have this widespread weakness across continental Europe. We're talking France and Germany in particular, that was just a major drag, pulling the entire group's performance down into the red. And this quote just brilliantly illustrates the disconnect, right? While the market was laser-focused on that group-level decline, you had the CEO, George Weston, pointing out these very real pockets of strength. He was talking up how they're gaining share in the UK because their women's wear is doing so well. It just goes to show you that the view from inside the company and the market's perception are miles apart right now.
But okay, as if the Primark weakness wasn't bad enough, it wasn't the only problem. The company's sugar division continues to be this major headache with these stubborn losses that are just weighing on profits and really testing investors' patience. And this really is the million-dollar question for this part of the business, isn't it? For years now, the market's been waiting for a turnaround in the European sugar business, but the recovery just keeps getting pushed further and further out, and that led to some pretty tough questions on the earnings call.
You can almost hear the frustration in the CEO's own words here. He basically admitted that this recovery is taking way longer than they thought it would. The core problem hasn't changed. There's just way too much sugar in the European market, which is keeping prices super low and making it impossible for even the best producers, like ABF's British Sugar, to make any real money.
So you've got this softness in Primark Europe and this nagging sugar problem. What is management actually doing about it? Well, the call laid out a pretty clear strategy to tackle these problem areas and try to get the whole portfolio back on track for more stable growth. The plan really boils down to three key things. First, de-risk the business by getting out of assets that aren't making good money. Second, find synergies by buying up businesses that make their core operations stronger. And third, reinvest that capital into the clear winners, the parts of the business that are actually growing.
And hey, this isn't just talk. We can actually see them putting this plan into motion. The de-risking part, that's the closure of their Vivergo bioethanol plant. For synergy, they're trying to buy the Hovis bread business, which they think will finally help them create a profitable UK bread operation. And for reinvestment, well, they're doubling down on that massive opportunity in the US with more and more Primark stores. All right, so let's put all the pieces together. What does all this mean for the stock? Let's give you our take on what to expect when the next earnings call rolls around on November 4th.
The whole investment case right now is really a tug of war. The bears, the negative folks, they're going to point to the weak European consumer and the fact that nobody knows when the sugar business will recover. But the bulls, the optimists, they'll highlight that phenomenal growth in the US and the real market share gains in the UK. The next earnings release is going to be huge in showing us which side of that debate is winning.
Okay, here's our call. We think Primark's Q1 like-for-like sales will probably stay slightly negative just because that European weakness isn't going away overnight. And after that massive sell-off, we see the stock pretty much stuck in a range for the next 3 months. For all those reasons, we're assigning a market perform rating. The bad news is pretty much baked into the price now, but you need a real catalyst to get it moving higher. The key question for investors now is this: can that explosive growth in the US finally be enough to outweigh the persistent drag from Europe?
And finally, before we go, just a quick and important reminder.
This analysis is just for informational purposes, and it's based on public information. It is not and should never, ever be considered financial advice. You should always do your own thorough research before making any kind of investment decision.